Hey, I'm Tom Dunkel, founder and managing director of Eagle Capital Investments. And Brian and I are going to have a great conversation about my experience in distressed mortgage debts, short-term rental, and also self-storage and my ups and downs and the mistakes I've made over the years and maybe even a couple of successes or two.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owners Association, where real estate investors have found success since 1968. I'm your host, Brian Hamrick from Hamrick Investment Group. This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Get ready for the Midwest Real Estate Investor Conference in Grand Rapids, Michigan. Join hundreds of real estate investors for networking, learning, and growth. Be sure to mark your calendars for April 24th and 25th of 2025. Hello and welcome to episode 471. Navigating the ups and downs of real estate investing requires skill, strategy, and the ability to adapt. But what if you could create a portfolio designed to thrive in any market cycle? My guest today, Tom Dunkel, has spent over 28 years mastering the art of real estate and finance. As the managing director of Eagle Capital Investments, he's raised over $65 million in private money and built portfolios in self-storage, short-term rentals, and distressed mortgage debt. Today, Tom will share his insights on building predictable portfolios and the lessons he's learned from weathering the booms, busts, and bruises of investing. Tom, welcome to the show.
Hey, Brian, it's great to be with you and all the listeners today. I'm looking forward to our chat.
Tell us a little bit about yourself. I mean, how'd you get started investing in real estate? And it sounds like you've been doing it for almost 20 years.
It's been a long time, so I'll try to keep my answer punchy because I tend to get a little long-winded as I age, you know. But yeah, I got out of business school and went into corporate finance and mergers and acquisitions in the aerospace industry, which was a fantastic foundation for doing deals and understanding finance. We were working with private equity firms on Wall Street and putting huge debt facilities in place and all this kind of thing. So it was a ton of fun. And that in my corporate life did over $1.2 billion of acquisitions and capital transactions. So that was a lot of fun. But fast forward to 2006, I got fired from my corporate finance job. And I looked at that as kind of the kick in the pants I needed to go out and do my own thing, which was what I had been wanting to do for a while, but it's hard to, make that transition. When you have golden handcuffs, I was a vice president at a publicly traded company. I had stock options and all those kinds of things. So, but when that day came, I knew that was really the opportunity to go and do my own thing. So 2006, I jumped into real estate. And of course, it was probably not the best time.
That was before everything went over the cliff, right?
That's right. It was not the best time in history to not only, jump into real estate, but also as kind of my first jaunt, going into entrepreneurship and kind of running the show myself. So, learned a lot of hard lessons those next few years as the market kind of crashed and I was spending a ton of money on marketing and I was doing a lot of wholesaling and picking up some rental properties, residential rental properties, doing some fix and flips. And of course, the market was just working against me the whole time. And out of the ashes there, though, I just remained determined to, do my own thing and figure something out. So especially because I had a wife and two young kids at home. But it was around 2010, 2009 that I discovered distressed mortgage debt. And so, kind of one thing led to another there. And we've built a great business over the last 14, 15 years in distressed mortgage debt. Our company there is called U.S. Mortgage Resolution, and we're pretty well known in our little niche. But that business has generated almost $58 million of revenue over that time period, which isn't bad for about a 4-person team. So we've done pretty well there. But along the way, we were looking at ways to kind of redeploy those profits into other areas. So we've done some hard money lending. We built up a short-term rental portfolio. And for the last 5 years, we've been doing storage. So Belrose Storage Group has acquired about 18 properties for close to $50 million of acquisition value. We've got about 4,000 units across 7 states. So I've had a kind of a nice run there as well.
I'm interested in the distressed mortgage. What niche are you doing there? Because I've done a little bit of that myself, and we kind of picked up some of the tail end of the Great Recession pipeline that was out there. What kind of distressed mortgages were you investing in?
So we were buying charged off second mortgages on residential properties. So a lot of people thought we were crazy going into that, and maybe we were. But when you go into those really kind of nuanced, niche areas, I think is where you're going to find a lot of profits, because you can buy a charged off, distressed first mortgage, for just, there's a lot of factors that go into it, but just to illustrate the point, maybe you'll buy that mortgage for 75 cents on the dollar. You're in first position, you're secured by the property, very secure spot. The second mortgage, though, we felt like they were disproportionately discounted. So a charged off second mortgage that's in default, you might be able to pick that up for 20 cents on the dollar. So it gives you a lot of room to work with the borrower to come up with a way to create a win-win solution so everybody makes money.
How have those fared over time? And have you found them to be kind of recession resistant?
Like I said, we're buying these loans at such a discount. It gives us a lot of flexibility in how we work with the borrower. Because the reason we got into the distressed debt business, because we didn't want to own the property. So the last thing we want to do is foreclose. So we've done very, very, very little foreclosing over the years. And plus, it's just, we feel like it's bad karma for a small organization, because obviously we don't want to put people out of their home. So if they want to keep the home, we're going to find a way to help them stay there. And so as a result, our redefault rate has been really pretty low on our portfolio. And the other thing we've done along the way, Brian, is we've developed what we call a downline of buyers. Our company has grown to the point now where we're buying direct from the banks. And so we're getting the best pricing, the best execution there. And now we have a downline of buyers that we've accumulated over the year that are, Tom and Joe of, 10 years ago, trying to get started in the business, or maybe they just don't have access directly to the bank. And so we will sell loans to those investors. And so we're able to monetize these loans in a number of different ways. We can sell them. We can do some kind of discounted modification payment plan with the borrower, or we can actually do a discounted payoff with the borrower. So they're paying off less than what's owed, but still more than what we bought the loan for.
And where would you put the market right now? I mean, we're at the tail end of 2024. I've noticed big changes just over the past 5 years that my team has been investing in distressed notes. Where do you think we are right now in the market?
We are still getting pretty strong pricing when we go to sell our paper. So it seems to be hanging in there pretty good, even though the market's the residential real estate market's been in kind of a tough spot the last year or so with the run up in interest rates, and transactions volume has really come to a screeching halt. But the paper that we're buying is typically maybe it was originated 3, 4, 5, maybe 10 years ago, and it's gone into default maybe just in the last 2 or so years, which is actually good, because for us, we kind of like there to be a little space between the default and when we buy the paper, because there was some life event that happened that caused these people to stop paying. So maybe it was they lost a job, or maybe they had a health issue, or maybe it was a divorce, or something else was going on with their life. So, fast forward a couple of years, there's a good chance that they've had some kind of resolution to that problem. And now they're back in a position where they're able to start paying again. So that's been our experience, Brian. But as far as the overall market, we love the distressed debt market. I think it's a great place for investors to make secured returns, which is great. And if you're buying them if you're buying just like regular real estate, if you're buying it right, you put yourself in a good opportunity to make money.
Let's talk about short-term rentals. I mean, that's another asset class that you're investing in. Tell us about some of the ups and downs that you've encountered in that market.
Short-term rentals, have become kind of super popular the past few years with Airbnb coming on board, and COVID was a huge driver of people kind of especially getting out of cities and wanting to go and maybe set up shop out in the country somewhere where they felt safer and not so close to other people where they're spreading infection and whatnot. So we definitely felt that in our portfolio. We had a big kind of run up in cash flow and popularity in our portfolio. And things have definitely cooled off since then, Brian. But the pricing, we've definitely have the appreciation in the assets. But I have to say that our portfolio, the cash flow has been less. The demand for that type of getaway has cooled off in this kind of post-COVID world. But it's still an opportunity for investors to make good money, because you don't need a ton of occupancy. If you're buying the asset right, you don't need a ton of occupancy. You don't need it full like the whole month to make money. You can gear that so that you're covering your mortgage and your expenses with just a handful of nights of occupancy, and then the rest is gravy. So that's how we try to gear our properties there. But it's definitely cooled off the last couple of years.
How do you pivot then going forward to say, okay, well, maybe our cash flow is not as much, but how can we still turn a good profit? Like, what have you had those conversations with your team?
Well, a couple things there. I mean, number one, I think we ended up buying some properties, and anybody out there who's has a portfolio of even regular residential rentals, let alone short-term rentals, you buy, you do your due diligence, you buy a property. Sometimes it just never performs to the level that you were expecting. And so we've actually had to prune our portfolio, because we ran into that with some properties where, they were doing okay, but they just weren't hitting the numbers that we were expecting. And the other thing there, Brian, is some municipalities are kind of becoming more sensitive to the short-term rental model, and they don't want it. So a lot of municipalities are saying, hey, we're not allowing short-term rentals in our municipality anymore. So we had to sell some properties because of that. And then, of course, when you sell a property, even if the cash flow hasn't quite been where we wanted, real estate has generally been, going up in value. And, even with the soft market we've had the last year or two, we bought them right, and we've accumulated some equity. So the properties that we identified that were underperforming, we were still able to sell them at a profit.
Well, let's talk about self-storage, because self-storage has been considered to be kind of a recession-proof asset, just because when times are good, people buy more stuff. They need a place to store it. When times are bad, they're downsizing. They need a place to store their stuff. I mean, what's been your experience with self-storage, and is that true?
Yeah. That's a great question, Brian. I have to say, we definitely steer away from saying recession-proof. We certainly say recession-resistant for the reasons that you just stated, which are, when things are going well and the economy's going well, people are buying stuff, and people tend to buy more stuff than they have room for. So they use self-storage as a way to, hold on to their, the extra stuff that it might be out of season. They might be storing their kayak and their bikes for the winter, their holiday decorations, whatever it might be. Well, and back to COVID, COVID was a huge driver of self-storage demand, because people had that spare bedroom that, oh, hey, all of a sudden we've got to turn that spare bedroom into a home office, but they don't want to get rid of the bedroom furniture because this is just going to be temporary. And so they store that. And then, anyone who has, maybe some aging parents out there and they're downsizing, and they hold on to their heirlooms, right, as they think of them. But then also, in bad times, right, like we've had some bad storms and some bad flooding recently, and that's people will store their stuff in self-storage if they think that their home might be impacted by a storm like that. Certainly after the fact, it becomes kind of a necessity. And then, of course, with people, there's of course divorce and other kinds of downsizing and displacements, death, the 4Ds that we call them are on the bad side of things, when the economy's not going well or things are not going well, people need storage for those kinds of reasons. So it does tend to balance out whether times are good or bad. And that's been the trend, Brian, for the last 40 plus years. The storage occupancy across the industry, across the country, has generally been in between 80 and 90%, whether things are going well or things are going bad. So that we definitely like self-storage for those reasons.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. Save the date for the Midwest Real Estate Investor Conference happening April 24th and 25th of 2025 in Grand Rapids, Michigan. This event is the perfect place to connect with fellow real estate investors, gain valuable insights, and elevate your real estate game. With a lineup of expert speakers and numerous networking opportunities, you won't want to miss it. And in your own personal portfolio, I mean, what's been your experience with self-storage?
Our portfolio, like across the industry, when interest rates ran way up, a year or so ago, and that really, hit the brakes on the residential real estate market. And so a big driver of demand for self-storage is the residential real estate market. So our portfolio definitely felt the impact of that, which was also felt across the industry. So our occupancies were down. We had to really lower our rates in a lot of places. So it was kind of a double whammy, our occupancy's down and our rates are down. But that seems to have kind of worked itself out. And so we've been working hard at our marketing, targeting. We're trying to target more commercial users. That was one thing we kind of learned from the slowdown in residential is, hey, there's plenty of, contractors and pharmaceutical reps, and there's people that have home businesses that might need storage as a solution. So we are, in our marketing, we're targeting more contractors and those home business kind of people to hopefully switch our revenue mix from purely residential to a mix of residential and commercial purpose.
When you look at the three asset classes we just discussed, I know you've got a team, you've got, systems in place, and you really are over time experiencing the ups and downs in each of those individual asset classes. How do you stay on top of that? Like what do you do with your team to say, okay, we're seeing a slowdown here. Here's how we're going to pivot. Like, what do you do to stay on top of it all?
We're big proponents of kind of lifetime education, right? So we're always out. We join mastermind groups. We get involved with them. We go to the industry conferences. We read the industry publications, and then of course we're looking at resources outside of real estate to learn about what's going on with the economy or what's going on with housing and those kinds of things. So it's really, it's not our first rodeo, right? We've been around for a while. And so we know the market goes in cycles. And so we just try to learn as much as we can from others that are in our industry, from resources outside of our industry. Because what we found over the years is, when you not to pick on Marcus and Millichat, but just as an example, Marcus and Millichat puts out a lot of great information about what's going on in real estate, right? They're an enormous real estate brokerage firm, and they have a financing arm, and they do all different asset classes. But at the end of the day, they're still in real estate. So some of their material is kind of biased towards real estate, and we're going to be getting out of this. But if you go and you look at resources outside of real estate, so even if you go to like Northwestern Mutual, or you go to Schwab, or you go to some of these more broad financial institutions, and you read their stuff, it's you get a little bit different flavor than just kind of staying in the real estate world. So we're looking at all those different things, and then of course we're looking at our actual portfolio. How are they performing? What's happening in that particular market? Unfortunately, in one of our facilities, we had a factory that shut down, and a lot of jobs were lost. And so that demand kind of left the market. And so, things like that happen. And then you just need to be able to see that, pivot. And, for us, we're big on marketing. So we have a marketing team that not only markets to investors to try to get investors to work with us and participate in our offerings, but we also have marketing for customers to place their goods at our storage facilities. So, we're looking at all those different aspects.
So we're recording this mid-November. The election has happened. I mean, people are anticipating change. What do you see ahead for you in the next year, 3 years, 5 years?
We are hopeful that more kind of business-friendly administration is going to help to bend the cycle curve back up here. But we've experienced it in the past where there is a lag. So I would expect maybe take 6 to 12 months maybe for that impact to be fully felt. But you're already seeing a lot of positive things happening in the equity markets. Crypto market's been going crazy. Interest rates, interestingly, have actually gone up a little bit recently. But as far as us, going out and getting financing for our self-storage facilities, we're still getting good execution on those in like the 7% range. I mean, it's not as good as the 4% range that we were in a couple of years ago, but still, I mean, that's historically, that's pretty good. But we're hoping that if we do run into a recession, it'll be short-lived. We'd like to see maybe the Fed reduce interest rates another time or two. I hear a little chatter about that. But, at the end of the day, Brian, we are not in the interest rate predicting business, So we focus on the things that we can control, like how we run our self-storage facilities, how diligently do we use, debt to finance our deals? What can we do to reduce our expenses? What can we do to increase our revenue? So those are really the things that we're working on day to day.
Tell our listeners how they can find out more about you, get a hold of you, and feel free to plug whatever you want to plug.
Sure. This has been great, Brian. Appreciate the time today. Yeah, so I'm Tom Dunkel. I'm currently Chief Investment Officer at Belrose Storage Group. But as Brian mentioned at the beginning of the show, I am also the Managing Director of Eagle Capital Investments, which is a brand new fund that I'm launching. And really, it's an opportunity for investors out there to take advantage of my 19 years banging around the real estate industry and finding fantastic operators in all different asset classes. So in the networking that I've done over the years, I found outstanding operators in mobile home parks, self-storage, of course, short-term rentals, multifamily, lending, all these different industries, all these different asset classes. So I just invite investors to find me on LinkedIn. You can find me on Tom Dunkel. If you Google my name, as it shows up here on the screen, you'll be able to find me pretty easily. There is a writer out there named Tom Dunkel. That's not me, but I do have a lot of videos and such out there. But if you direct message me on LinkedIn, I'd love to schedule a call with you and tell you about the exciting opportunities I'm seeing out there in these different asset classes with these outstanding operators that I've gotten to know over the years.
Tom, what's your favorite hack or app?
I've always felt like people, myself included, like we've got a lot going on, in our financial lives. So I've actually I've been using an app called Monarch over the past probably, I don't think it's quite been a year, but Monarch is a really, it's simple to use, but it has some sophisticated features for personal finance. So it hooks in with my bank accounts, and I can track my investments in there, and also my private investments, and my cash flow and my net worth and those kinds of things. So I think it's important for people to have some strong visibility into their personal financial lives. So I think, unfortunately, that gets lost in kind of everybody's day-to-day busyness, but it doesn't take a lot of time. Once you get it set up, it actually pulls in all your transactions automatically, and you can just track your income and your spending and your saving, and you can set goals for yourself and all that kind of stuff. So I would encourage folks out there to do that, so you can carve out some of your hard-earned money to invest in assets like self-storage and short-term rentals, etc.
Does Monarch provide like a PFS, a personal financial statement?
I use it to create my personal financial statement, but it's not one of the kind of canned outputs of it. But it's very easy to pull the figures out of there and drop them into your personal financial statement template.
Well, Tom, appreciate you coming on the show to talk about the ups and downs of your career investing in real estate, between the distressed notes, the short-term rentals, and self-storage. And then, what you plan on doing in 2025. I wish you the best of luck, and I appreciate you coming on the show today.
Thanks, Brian. It's been great to be with you and all the listeners.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. And remember to save the date for the Midwest Real Estate Investor Conference on April 24th and 25th of 2025 in Grand Rapids, Michigan. It's going to be an event you won't want to miss, packed with invaluable sessions and opportunities to connect with like-minded investors. Keep listening for more updates, and we look forward to seeing you there. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.